Joining us now is Irene Tunkel, Chief of Strategies at BCA Research. Irene, great to have you back on the show. Thanks for joining us. Let's take a look at what you're seeing with the US economy at the moment. In fact, we've just had a read on private sector jobs. That was much weaker than expected. What are you seeing in the US economy at the moment?
Yeah, hi Andrew. Thank you for having me back. I think that there is no doubt that the US economy is deteriorating and job growth is weakening, job market is softening, like you use the adjective, but I think that it's quite clear that that we probably are downshifting in terms of growth. I think that where people differ is like what is going to happen next. And I think that optimists think that, the fact that fewer jobs are created will create an impetus for the Fed to lower interest rates. And the pessimists are saying, well, economy is edging towards the recession and the Fed will not able to rescue it. And that I think is in short describes sort of the difference between the two camps. But I don't think there is much argument about the fact that the US economy is slowing.
What's your expectation as far as interest rates are concerned? Because clearly the Fed is saying they want to wait and see, particularly with the effect of these tariffs. And of course, coming up to that key date of July 9th.
Yeah, no, absolutely, because the Fed is kind of torn because they have a dual mandate. They have to take care of inflation. They need to make sure that we're not going to have another spurt, because of the tariffs. But at the same time, they also do care about job creation. I think the fact that jobs are slowing, but at the same time, so far inflation readings was somewhat contained, gives us a little bit more confidence that the Fed will be much more hawkish and much more aggressive in cutting the interest rates. So I think that so far, obviously, the jury's out, but to my mind, I think that the balance is now shifting towards jobs, and I think the Fed's attention will be on the jobs number tomorrow. And by the way, the ADP jobs report is not always correlated with the main jobs number, but what we've seen today kind of points to some weakness for sure.
Are you willing to say when the Fed will cut again?
Yeah, I think that we expect the Fed to start cutting in September. We expect 2 cuts in September. It's not very different from the dot plot. There is a little bit, of bifurcation among the members of the open market committee. Some people are more hawkish, some people are more dovish. But I think on balance, it's fair to expect 2 cuts this year and quite a few next year. And I think that I'm a little bit more bullish, on the outlook for U.S. equities, simply because I do expect monetary easing, and I hope it will offer some support for the market.
Well, also there's the issue of the weakening US dollar. How supportive is that particularly for earnings growth?
Well, it really depends on which asset class you look at. But I think for the large cap, which is the home of the U.S. multinationals, it's simply it is a sort of a silver lining. On the one hand, of course, they are paying much more. The companies pay much more for tariffs, and the input costs are going up because of the weaker dollar. But at the same time, the S&P 500 is the home of some of the largest companies in the world, the home of multinationals. The index derives around 40% of sales from abroad, which means that they also benefit, these companies benefit from the weaker dollar, because whatever they're selling abroad is kind of cheaper, to customers. But at the same time, you also benefit from the sort of accounting translationary effect when you convert earnings back into dollar. If you look at small caps and mid caps, I think that weaker dollar is just a definite sort of negative. It's a headwind. But I think that large caps, mega caps do benefit from a weaker dollar.
So Irene, you're broadly constructive on the outlook for US equities then. What are the potential risks you're seeing right now?
Well, I think that we still have a lot of uncertainty. July 9th is coming up. Again, I'm hoping it will be, a non-event, but you never know with Trump, even though we kind of became desensitized to, his negotiating tactics. Let's put it this way. So I hope that we will have some sort of benign outcome. But again, we don't know. And at this time, the index is quite expensive. So any shock could actually propagate and bring down the multiples. The conflict in Middle East, it kind of, it seems to be in a rare view window, but I think that you can always expect a flare up. And I think that what is important here is at this level of valuations, when the market have run up so much, it becomes more fragile. And so any bad news can be taken, very badly.
Yeah, you talk about the run up in the market. Obviously, new records again for the S&P, for the Nasdaq, but very much driven again by those mega cap tech stocks. What's your view on those stocks at the moment?
I think that since we started this conversation, we've been talking about slowing growth in the US, and in the environment of slow growth, investors are willing to pay premium for companies that have been able to consistently generate growth. And we had quite a bit of debate this morning at the BCA during our morning meeting. Earnings growth of the Big Seven, of the Magnificent Seven, and earnings growth of big tech is slowing down from some of the levels of really, really high growth that we've seen in 2024, 2023. Doesn't matter. I think that on the one hand, second derivative, which is deceleration growth, is a negative. But on the other hand, if you look at the big tech, if you look at the Magnificent Seven, in cross-section, it still looks so much better than everything else that it certainly commands a premium. And so I'm bullish on tech, and I'm bullish on the Magnificent Seven.
Overall,
these companies are growing.
Okay, yeah. Well, overall then, Irene, where do you want to be overweight and where underweight?
I think that at this point, I would think a little bit that you have to be tactical. There are certain investment themes that are floating around in the market. I think you can leverage those. So what do we see? We see the AI adoption. So this is technology. So I think that theme is very strong and it plays into the hands of technology. And that's something that we have just talked about. But for example, aerospace and defense. Yes, the Israel-Iran war is kind of behind us, but at the same time, now NATO is spending so much more on, military spend on military. The big beautiful bill is setting aside much more money on military spending. So I think it's definitely a plus for aerospace and defense companies. And most of the European spending on defense actually goes to the U.S. defense contractors. Cybersecurity. So much is going on. There's so many cyber attacks. I think you can be very tactical. Again, it's kind of a play on technology, but it has a slightly different sort of twist to it. So I'm very bullish on cybersecurity. There are plenty of ETFs out there. I think it may be a good time to top up defensives. Utilities used to be very, very expensive and used to be a very, very crowded trade. Now it looks much more attractive. So I'm thinking of putting money into utilities. And overall, I think a barbell will work really well. So maybe technology and a few defensives in your portfolio to give you ballast in case the market kind of turns on us.